Welcome back to the deep dive. You gave us the stack of research and, well, we're here to provide the shortcut.
That's the plan.
Today, we're diving deep, doing a really intense forensic analysis of something absolutely core to the AI revolution.
Right. The semiconductor equipment and material sector.
Exactly. This isn't about making the chips themselves. It's about making the machines that make the chips a critical layer.
Absolutely critical. And we've got a solid source stack here, a pretty comprehensive stock screener, detailed quotes. Basically everything for the three biggest players by volume and market cap.
Which are?
Lam Research, ticker LRCX. Then Applied Materials, AMAT, and Teradyne, TER.
Okay.
Now, the context is super important for understanding this data, our analysis. It's pinned to October 10th.
And that date matters because?
Because the whole sector got hammered that day. Seriously hit. We're talking major geopolitical worries. And all three of these stocks saw significant drops, down between like 4.7% and over 9% in just one session.
Ouch. Okay, so our mission here is to cut through that noise, that volatility, and really unpack the core fundamentals.
Right. Are these stocks just caught in some temporary turbulence, or is there a more systemic risk showing up?
We'll look at their financial health, now the technical indicators, what news might be driving the price action.
And we'll run some hypothetical paper money math, too, just to get a feel for the risk-reward picture. And of course, we absolutely have to state this clearly. This discussion is purely for informational and educational purposes. It's based only on the data we have in front of us.
Right.
It is not investment advice, not a recommendation to buy or sell anything. We're just, decoding the data for you.
Got it. Okay, let's dig in. First up, Lam Research, LRCX. Still a powerhouse, right? Market cap over, what, $165 billion?
Yeah, even after closing down almost 7%, 6.83% to be exact, on the day we looked at. Closed at $131.37.
So the big question is, can the fundamentals justify the kind of momentum needed to bounce back from a hit like that?
Well, the short answer, yeah, probably. Their balance sheet is phenomenal, frankly.
Right.
When you look at profitability, LRCX is pulling in a return on equity ROE of 58.24%. That's huge.
58%. Wow. Explain ROE again quickly.
It's basically how well they use shareholder money to make profit. Almost 60 cents profit for every dollar of equity. And they do this with pretty moderate leverage, too. Debt to equity is only 0.48.
So efficient. Very efficient.
The profile of a highly efficient manufacturing giant. Exactly.
And that efficiency must be feeding growth, right?
Oh, yeah. Massive growth. The momentum is just undeniable. Quarterly sales growth, 33.58%.
Nice.
And quarterly EPS growth earnings per share surged by over 73%.
73. They're basically printing money.
Pretty much. And the valuation reflects that expectation, but, it's not completely off the charts.
What are we talking PE-wise?
Trailing PE is 31.59. But the forward PE, looking ahead, drops to a more comfortable 25.38. The market's pricing in continued success, basically. They expect about 12.36% EPS growth per year for the next 5 years.
All right, let's pivot to the charts, the price action. Lam Research has been, well, a monster momentum play this year, up over 80% year to date.
Yep, 81.88% YTD, and almost doubled up 97.76% in the last 6 months alone.
But that drop on the 10th was sharp. What does that do to the technical picture? Is the trend broken?
It creates this really interesting contrast. See, despite that nearly 7% drop, the stock price is still riding almost 46% above its 200-day moving average.
So the long-term trend is still very much up.
Incredibly strong, yeah. Intact, despite the noise. But, and this is key, that days selling pushed it just below its short-term 20-day average, about 1.5% below.
Ah, so immediate momentum is cracking a bit.
Exactly. It tells us the short-term trend is wavering. And you absolutely have to remember the beta. It's 1.86, meaning it's highly volatile. It reacts almost twice as strongly, plus or minus, as the overall market to news. Wild swings.
And that volatility ties right into the geopolitical stuff, doesn't it? Lam Research got a boost from AI buzz in September, even a Deutsche Bank upgrade.
Right. But the big cloud hanging over everyone is this concern about the U.S. Slamming China sales with new chip export rules.
That seems to be the main driver for that sharp daily drop across the board.
Definitely the major headwind. Okay, so given that huge volatility, that massive run-up, then the drop, what did that ride feel like? Let's do some paper money math.
Okay, hypothetical $3,333. Where do we start?
Let's say you hypothetically bought near the 52-week low. It was $56.92. Let's just round up to an easy entry price, say $60.
Okay, $3,333 at $60 a share gets you 55 shares, rounded down.
Right, 55 shares. Now, if you held those and managed to sell near the 52-week high, which was $153.70, so let's be conservative and say you sold at $150,
Okay.
your hypothetical paper profit would be $4,950.
Wow. Almost $5,000 on a $3,300 investment. That shows the potential, but also the risk needed for that timing.
Exactly, it captures that momentum. And here's the kicker. Even after that big 7% hit on October 10th, if you just held those 55 shares, at the closing price of $131.37, they'd still be worth $7,225.35.
So you more than doubled your initial $3,333, even with that nasty drop yesterday?
Yep, 117% return from the low, despite the dip. That tells you something about the underlying institutional belief in LRCX.
Okay, let's shift gears to applied materials.
Yeah.
AMAT, slightly bigger market cap leader here, right?
Yeah.
Around $167 billion.
Just slightly larger, yeah. And its drop on the 10th was a bit milder, comparatively, down 4.7% to close at $209.89.95.
And AMAT's a bit different. They have those other segments too, services and display tech.
Right. They're diversified beyond just the core fab equipment, though that's still the main driver. Semiconductor systems is the big one.
Okay, fundamentally, how does AMAT stack up?
Fundamentally, AMAT kind of looks like the relative value play in this group.
Value play. Interesting one.
Well, profitability is excellent, don't get me wrong. ROE is 35.64%. But the balance sheet, that's what really jumps out. It's almost spotless. Super low debt-to-equity ratio of just 0.35.
Okay, very little debt. That gives them flexibility.
Huge flexibility, financial strength to weather storms, you know.
And the valuation supports that value label.
It certainly seems to. AMAT has the lowest PE in this group, 25.03, and the lowest forward PE, too, at 22.03. And historically, they've shown strong growth. EPS over the last 5 years averaged 24.62%.
Wait a second, though. Okay, value play on paper, lowest PE. But didn't we just say the big news here is that specific quantifiable risk from the China export curbs?
Exactly.
Applied Materials themselves warned about a huge potential revenue hit, right? Like $600 million to $710 million in 2026 revenue gone.
That's the number they put out, yeah.
So how can the forward PE be so low if the market knows about that? Isn't it cheaper for a pretty scary reason?
That is the absolute critical tension with AMAT right now. You nailed it. Analysts must be pricing in. Well, either a belief that AMAT can successfully pivot away from that dependency, or maybe that long-term growth outside China in etch deposition tech will eventually compensate.
Or the market just hasn't fully priced in that long-term hit yet.
That's the other possibility. The low PE suggests either extreme confidence in their adaptability, or maybe that the market's still digesting the full impact of that geopolitical storm cloud. It's arguably the highest risk-reward trade-off of these three because of that known factor.
Interesting. Okay, what about the technicals? How did AMAT look before the drop?
The chart reflects a strong prior trend. AMAT had been doing really well, up over 23% in just the last month leading up to this.
Okay.
So even after that 4.7% drop on October 10th, the stock was still trading above its 20-day moving average by about 3.4%.
Ah, so unlike LRCX, the short-term trend hadn't quite broken yet. It absorbed the shock better.
Exactly. The previous upward momentum was strong enough. And we can't ignore the positives either. Despite the China warning, they recently announced a big partnership with Global Foundries focused on accelerating AI-powered photonics. That's a huge futuristic growth area.
Photonics, okay.
Plus, Morgan Stanley upgraded them to overweight just in late September. So it's this real battle, immediate geopolitical risk versus long-term tech opportunity.
All right. Let's run the paper money math for AMAT. Same deal. Hypothetical, $3,333 allocation.
Okay. The 52-week low for AMAT was $123.74. Let's use a nice round entry number, say $125.
$3,323 at $135 gets you 26 shares. Rounded down again.
26 shares. If you hypothetically sold those right at the 52-week high of $226.49,
yeah,
the paper profit would be $2,638.74.
Still a very nice gain. Almost double the money from the low to the high.
Decent return, absolutely. And if you held those 26 shares through the drop to the October 10th close of $209.95,
what's the value then?
They'd be valued at $5,450.70.
Whoa! So that's still a 63% gain on the initial $3,333, even holding through the China news hit. From the low point, I mean.
Represents 163.76% return on that initial allocation from the trough. Yes. Shows you how strong the run-up from the yearly low was, even with that geopolitical cloud forming.
Okay, final one. Teradyne, TER. This is the smallest of the three, right? About $21 billion market cap.
Yep, smallest of this top tier.
And it took the biggest hit on analysis day, down 9.03%. Oof. To $132.08.
Steepest decline of the group, yeah. Over 9% in one day.
For a company that size, that's not just a wobble, is it? That feels like panic selling almost.
Yeah.
What makes TER so sensitive?
I think that sensitivity comes from its specific business mix and maybe more importantly, the high expectations built into it.
Okay, how so?
Well, they do semiconductor testing like the others, but their real differentiator is their robotics segment. Think collaborative robot arms, industrial automation. It's a different angle.
Interesting. And financially?
Financially, they are squeaky clean on debt. Debt to equity is tiny, just 0.03, almost nothing. And critically, they boast the highest gross margin of all three. 58.84%.
Highest margin. Okay. But the valuation, I saw the PE ratio is 45.81.
Eye-watering, isn't it?
Yeah. That's way higher than Lam's 31 or AMAT's 25. That screams growth stock, right?
Yeah.
The market must be betting big on that robotics piece and their testing tech.
Precisely. That high PE is absolutely justified by future expectations. It's all baked into the price. Their projected EPS growth for just the next year is a massive 44.40%.
44% growth expected next year. Okay. That explains the premium valuation.
The market is definitely betting those future earnings will catch up fast, especially with things like winning that TSMC 3D Fabric Testing Partner Award confirms their role in, next-gen chip tech.
Gotcha. What about the recent price action, besides that 9% plunge?
Exceptionally volatile. While its year-to-date performance is actually the lowest of the three, up only about 5%,
Yeah.
the stock absolutely surged in the last quarter alone, up almost 39%.
39% in a quarter, then down 9% in a day. Wow.
Exactly. That plunge just confirms its high volatility. The beta is 1.87, slightly higher even than LRCX.
Yeah.
Very twitchy.
Was there a trigger for that quarterly surge?
Oh yeah, a very clear one. Better than expected Q2 earnings back in late July, driven by really strong chip testing demand. That news popped the stock nearly 19% in a single day.
So very event-driven.
Very. And analysts are generally positive despite the volatility. Susquehanna, for instance, reiterated a positive rating and a $200 price target just in late September. That's way above where it's trading now.
Okay, paper money time for TR. This seems like a shorter-term, event-driven trade example might fit best.
Makes sense. Let's use that Q2 earnings pop. Say you hypothetically bought right before that surge using the July 29th closing price. Insider data suggests that was around $105.73.
Okay, $3,333 invested at $105.73 gets 31 shares. Write it down.
31 shares. Now, if you simply held those shares through the ups and downs until our analysis date, October 10th, closing at $132.08.
What's the damage or the gain?
It's a paper profit of $816.85.
So a decent gain in, what, about 2.5 months?
Not bad at all. Those 31 shares would be valued at $4,094.48 on October 10th.
Which is about a 23% gain on the initial allocation.
Represents 122.84% of the initial $3,333, yeah. Perfectly shows how catching a specific positive event in this kind of high beta, high expectation name can generate pretty quick, significant gains, even with the bumps along the way.
Okay, let's try and synthesize all this. We've looked at three really distinct risk-reward profiles here.
Definitely distinct.
You've got applied materials,
Yeah.
AMAT, kind of the relative value play,
Yeah.
lowest PE. But it comes with that known, quantifiable China revenue risk hanging over it.
Right. The big question mark.
Then Lam Research, LRCX, that's the high momentum play. Amazing historical profitability, huge long-term technical uptrend, still mostly intact.
Growth engine.
And finally, Teradyne, TER. That's the pure high-growth bet, priced really aggressively because of robotics and that massive expected earnings jump. But wow, is it volatile?
Extremely volatile, and the common thread tying them all together, besides being in the same sector.
Volatility.
Yep. High beta across the board, near 1.85 for all of them, and clearly all reacting strongly to that immediate geopolitical headwind around U.S.-China export rules.
Okay, here's something I found really interesting digging through the data. The institutional ownership. It's incredibly high for all three, isn't it?
Exceptionally high. You noted AMAT around 80%, LRCX 85%.
And Teradyne was listed at over 100%.
Yeah.
Like 102.65%.
Yeah.
How does that even work?
Yeah, that 100% plus figure usually comes up due to things like short interest reporting or how derivatives and borrowed shares are counted in the float calculations. It essentially means nearly all the effectively available shares are held by large institutions.
Okay, so it's not just an academic number. This concentration is significant.
Hugely significant. When ownership gets that concentrated, where almost the entire public float is in the hands of big funds, big institutions, it fundamentally changes the market structure for these stocks.
How so? What does that mean for, the average person watching these names?
Well, it means that the collective actions of just a few major players can have an outsized impact. Their reaction to external risks, like those China export rules we keep talking about,
Yeah.
it becomes a force multiplier for volatility. If just a handful of those giant institutions decide simultaneously, okay, we need to trim our exposure here based on shifting geopolitics,
The selling pressure gets amplified like crazy.
tremendously. It leads directly to the kind of severe sector-wide price swings like we saw on October 10th. That 9% drop in tier wasn't likely millions of small investors panicking. It was probably concentrated selling from a few big players adjusting positions.
So the takeaway for you watching this space is what?
It's that short-term price moves in this specific, highly concentrated sector are probably driven less by broad market sentiment or retail activity, and much more by the large, calculated movements of a relatively small number of very big hands. Something to definitely keep in mind when you see those wild daily swings.